We're really taking a deep dive into annuities. What I'm going to share with you today, I bet 99.9% of you probably don't even really understand how insurance companies work and how they invest their money. Folks, you got to think about something. When you turn over your money to anyone, an advisor, that advisor generally turns it over to an institution. Now, it's not that you have to score 100 on what insurance companies do. We're talking about education here, but you need to have a basic understanding, because once you understand how the insurance companies or Wall Street or whoever, municipal bonds, doesn't matter, how they work and how they earn money, then you'll understand how much money you might make on that money. Okay, so what we're going to do here, the question is basically how insurance companies work. How do they work? And, it's funny, I saw an ad the other day from a gentleman, kind of an older gentleman, very gnarly, looked real upset over something, talking about how much he hated annuities. And he's talking about how insurance contracts are this thick, very complicated. And I said, well, I don't think they're complicated. I mean, first of all, if you're too lazy to read the insurance contracts, don't bash annuities if you don't understand them. They're really not that complicated. And let me show you why. Okay, so here's how this works. You're the saver, okay? And it can be any amount of money. It could be your 401k. You could have received an inheritance. You got an old IRA, money in the bank. And you say, you know what, I think I want an annuity. I think I want to set up some of my money where I can have a guaranteed income for life, or what you call, Tony, mailbox money. Okay, we're on the same page. So what happens? Well, again, you're the saver, and let's just call this $100,000, all right? So you have $100,000. And notice that's called the premium. So the premium goes through something called risk. You have to remember something, folks. Insurance companies' main purpose, they're not investment firms, they're not Wall Street. This is why Wall Street many times doesn't like insurance companies, and the insurance world doesn't deal much with Wall Street, really. They're basically two different entities. Insurance companies are there to protect your money. Wall Street's there to try to grow it. It's not, nobody's right, nobody's wrong. It's just they're totally separate entities. So what insurance companies are doing, the reason you pay them a premium is you're trying to reduce or mitigate risk. Think about car insurance. That's the basics. We all understand that. You write a premium, let's say it's $1,000 every 6 months, because if you have a bad accident, you don't want somebody suing you for $1 million, right? So you give the money to the insurance company to mitigate risk. So what is the risk with an annuity, Tony, with mailbox money? Outliving your money. Folks, if you put your money with Wall Street and you're drawing all this money out and one day the market crashes, you could run out of money. So you don't want to take that risk with all of your money. That's why we give it to the insurance company for mailbox money. Now, what does the insurance company do with this? Do they go out in the stock market and invest it, Tony? No, they can't. They have to keep this money safe. Why do they keep it safe? Because remember, they could have a claim. You could live a long time with an annuity. They may have to pay you a lot of money that they hadn't planned on. If you have life insurance, you could die at a young age and then they have to pay a lot of money. You could have a bad car accident. The premiums you paid to them didn't even come close to covering the accident. So they have to invest your money very, very safely. So if you're a saver, you should like the sound of this. The money is not in the stock market. So how does this work? So let's just say, for instance, they go out and invest it in a pool of bonds and mortgages, very good stuff. Right now the yields are down. So I will say this, on annuities 10 years ago, it's funny, annuities weren't that popular. I was one of the first in the country nationally advertising these products after 9/11. I've sold over $350 million personally, written over 2,000 contracts, been using these products forever. Really 10 years ago, they were actually a little better than they are today. Why? Because bond yields were higher, and you'll see in a minute, they could pay us more money. Bond yields have come down. The Federal Reserve, the effect of the low interest rates is now starting to affect insurance companies, okay? They're having trouble finding high yields with safe investments. See their dilemma. They got to keep it safe, all right? So let's just say they make 5%. You say, oh good, do I get 5%? No, you don't get 5%. Because in here, they have expenses. And we'll just call it 2% of the 5. So on $100,000, they take your 100, they go out and invest it, and let's say they make $5,000. Well, they've got $2,000 they got to use for expenses. They have overhead, they have staff, they have computer systems, they have buildings, they have people like me and other advisors that they have to pay commissions. The insurance departments require them to set up reserves, right? They have to have large amounts of money set aside. Now, banks don't set aside a lot of money because they don't have all these potential claims. See what I mean? Wall Street doesn't have any money set aside. It just goes right back into the companies. They don't have any guarantees they have to offer. So insurance companies have to set aside a lot of money for expenses. So in this example, now remember, this is important. We're recording this show on October 1st, 2019. So if you dig this out of the archives one day in 5 years, I don't know what interest rates are going to do. So this is relevant to today, okay? So this example, on average, this is on average, could be higher, could be lower. That means you, all right, get about 3% on your money. If they make 5, they have to keep 2, that's called the spread, and they pay you 3. Is this making sense? Okay, so you say, well, what can I do with the 3%, Tony? If this is my money, what can I do with it? Well, that can come out to you, and you can take it in the form of cash. So let's just say it made 3%, and you say, no, give me that money. Leave the principal with you, insurance company, but I want my money at the end of the year or on a monthly basis. They would send you $3,000 or $3,000 divided by 12, and you would get that throughout the year. And your principal's protected. You'd still have $100,000, as you'll see on certain annuities, at the end of the year. Or you could say, well, Tony, I don't really need the money. I'm in a high tax bracket. I'd like to defer some taxes. This money is really for retirement. I don't want to touch it. Excuse me. They could just take the 3% and it stays right with the company. So then the next year, in that example, you would have $103,000. So remember, here's the basics on insurance companies. Insurance companies are in the business of taking on risks that you don't want to handle. That's their job. As they take on those risks, remember, they have to invest that money in a very, very safe environment. So they're not going to earn a large return on your money. You might be sitting there going, Tony, I don't know about this, partner. I was at a dinner seminar the other day, and I heard a fellow say I could get 8% on my money in annuity. We'll get into that later, folks. That's the kind of thing that's almost deceitful. Some of the stuff I'm hearing. Those are called payout rates, income riders. That has nothing to do with what you're actually making on your money.